Top 5 stocks to buy now in September 2021. Hey, what's up guys? Welcome to the Watch Investing channels where you learn about stocks to buy now, investing strategies, and other finance topics. The number one stock to buy is Tesla, and here are the reasons why. Tesla is an American electric vehicle and clean energy company based in Palo Alto, California. Tesla's current products include electric vehicles, battery energy storage, solar panels and solar roof tiles, and other related products and services. They are at the forefront of a new, hot, and in-demand industry. The current share price after split is around $715 per share. In the last 5 years, Tesla has returned around 1,486%, which works out to be around 297% per year. That is much higher than the average stock market return, and you will be growing your portfolio extremely fast if you had invested in Tesla over these last 5 years. Tesla's current market cap is around $708 billion. Therefore, if you believe that Tesla can become a $1 trillion or $2 trillion company in the future, just like Apple or Amazon, then that means there's still more room for returns for investors. Tesla's stock is currently down around 18%. So if you see it in a negative way, you might be fearful, but if you see it in a positive way instead, then you can think that this is a chance for you to make 20% return, because when Tesla rebounds back to its all-time highs, you will be making around that much or even more than that. And now what's even more exciting to look at is their quarterly growth per year. If we look at their revenue, it is up 98% over the course of 1 year. Imagine growing your business 100%, a huge business as Tesla, by 100%. That is amazing. And we look at their net income, it is up 998% over the course of 1 year. They 10x their profits over the course of 1 year. Like, that is a very difficult thing to do when your company is that huge, but Tesla is able to do it. It means that Tesla is finally focusing or allowing their business to retain huge amounts of their revenue, allowing their business to retain huge amount of profits. As you can see in their quarterly earnings growth chart, Tesla's earnings is growing quarter after quarter consistently, and that is the type of business that you want to invest in, a business with predictable cash flow that is constantly increasing. And if we look at their annual earnings growth chart, it is the same case as well. It is consistently growing over the time period. Tesla's earnings are projected to grow, and Tesla has already beat analyst projections twice in a row this year. Therefore, they might be able to continue this trend and continue to grow their earnings greater than the analyst projection. Current analyst price target for Tesla is around $704, and that is around the current share price that Tesla currently has. Therefore, analysts do not believe that Tesla will increase in value anytime soon. They think that Tesla is already correctly valued at the current share price that it has. However, I do not think that that is the case. I'm a strong believer in Cathie Woods and Chicken Genius Singapore. I believe that they are smart people, they know what they're talking about, and that they understand economics. And what these smart people do is that they are highly invested into Tesla. Tesla makes up the biggest proportion of their portfolio because they believe that Tesla will give them the best returns out of all their other stocks. And therefore, they think that Tesla has a much higher price target than what analysts believes. And therefore, I think that Tesla will also has a higher price target and will also give investors huge returns in the future. Analysts recommend you to hold the stock. Therefore, I would recommend you to buy and hold the stock. I believe that it's also important to look at the fundamentals of the business. The fundamentals of the business will help people determine whether a company will continue to exist and grow into the future. One of the methods of looking at the fundamentals of the business is look at the market share of the business to determine whether the business has a moat around it. According to Electric.co, Tesla owns 79% of the electric car market share in the US and owns 18% of the global market share. Therefore, I think that Tesla is a dominant company in this space, and therefore it has a moat around the company. The number 2 stock to buy is Shopify, and here are the reasons why. Shopify is a Canadian multinational e-commerce company based in Ottawa, Ontario. It is also the name of its proprietary e-commerce platform and retail points of sale system. Shopify helps people without coding skills build beautiful e-commerce websites where buyers can transact with them online. The current share price of Shopify is around $1,545. The current market cap is around $192 billion, therefore it has the potential to 10x or 20x to reach $1 trillion or $2 trillion valuation. And over the last 5 years, it has returned around 3,800%. Shopify's quarterly revenue and net income growth year on year is even crazier. Shopify's quarterly revenue growth year on year is 56%, while the quarterly net income growth is 2,300% year on year. Analysts give Shopify a buy rating with the highest price target being at $1,900 and the average price target being at $1,515. Now we're going to look at the fundamentals of Shopify to determine whether Shopify is a good company to invest in, a company that will grow and exist into the future, because we want to invest in stocks that will give us huge returns over a long period of time. One of the methods to look at the fundamentals of a business is look at the market share of the business. Shopify has a market share of around 23% of the global e-commerce platform market share, which is 3% less than WooCommerce. However, what's amazing is that Shopify charges a subscription service. They charge more than their competitors and still are able to maintain a huge market share, which means Shopify is a unique business and has a moat around their business. They're able to have a huge market share despite charging more than their competitors. The number 3 stock to buy is Apple, and here are the reasons why. Apple is an American multinational technology company that specializes in consumer electronics, computer software, and online services. Apple is the world's largest technology company by revenue, and in 2021, the world's most valuable company. They're most known for their hardware products such as iPhones and iPads. And in the last 5 years, they have returned 440%, which works out to around 88% per year. So it returns like 8 times higher than the average stock market return. And at the same time, it is also a safe investment. Apple is a blue chip stock, so it's a safe investment that gives you a higher return. Wouldn't that be a good investment? And the current share price is around $146. That is based on the share price when I researched before, but now when the video uploads, the price will probably be a bit different. And the revenues, quarterly revenue year-on-year growth is 36%. Their net income year-on-year growth is 93%. So their revenue is increasing, and at the same time, the net income is increasing by a lot, which means they're starting to break in those profits after years of growing their revenue. And they, despite their high valuation, I mean, like, they're the most valued company in the world, but that doesn't mean they have a high PE ratio or whatnot. But they have an average of a buy rating, so analysts recommend people to buy this company. And it also pays out a dividend, so for people who love dividends, it even pays out dividends. So it's like a good stock in all shapes and form. It pays a dividend of $0.88 per share, 0.88 cents per share, I don't know, which is a dividend yield of 0.60%, and the dividend amount has been increasing consistently. The 4th stock to buy is Microsoft, and here are the reasons why. Microsoft Corporation is an American multinational technology corporation which produces computer software, consumer electronics, personal computers, and related services. They are most known for their software product called Windows. In the last 5 years, it has returned around 400%, which equates to around 79% per year. That is like 7-8 times the average market return. The current share price at the time of research was $289. And what's amazing is that their revenue year-on-year growth, despite the size of their company, is probably like around $1 trillion company now. Despite that, they're still making around a 21% revenue growth year-on-year. The net income growth year-on-year is even higher. It's 46.92% year-on-year. So despite existing for a long time and being a $1 trillion company or more, they're still able to grow their net income by 50% per year, which is insane. Analysts give it nearly a buy rating. The average price target is around $298. And now let's look at the fundamentals of the business to see whether Microsoft will be a business that will continue to grow into the future. And to that, one of the ways to do that is to look at the market share. Microsoft is the dominant desktop operating system with a market share of 73%. That means they control most of the market, which means they're able to continue to grow with this industry, which is continuing to grow. Microsoft pays a dividend of $2.24, which equates to a dividend yield of 0.77%. And this dividend payout has been consistently paying out and also increasing. So your dividends will be increasing over time. And the 5th stock that I recommend to buy is Vanguard Tech. I'm not too sure if it's a stock or what, but what I know for sure is that it is an index fund. And it trades just like a stock. You can easily buy and sell. You can buy and sell whenever you want. And here are the reasons why you should buy Vanguard Tech. Vanguard Tech seeks to track the performance of a benchmark index that measures the investment returns of stocks in the information technology sector. It holds 357 stocks, so it holds a huge basket of stocks, and its top 10 holdings makes up 57% of its entire basket. The top 10 stocks are Apple, Microsoft, Nvidia, Visa, PayPal, MasterCard, Adobe, Intel, Salesforce, and Cisco. These are all great companies, I think, except two, which is like Cisco and Intel. They're like old companies that are losing out, that are not performing that well anymore. And through owning this index funds, you'll be owning a basket of technology stocks. So you don't have to worry about picking the right technology stock. You don't have to worry about picking a technology stock that is too overvalued and therefore it might crash and take you 20 years to break even. You don't have to worry about that because since there's a basket of stocks, the valuation will be around the average market valuation of the tech industry. And therefore there won't be much volatility in the stock price, which gives you more stable returns and allows you to consistently grow over the years rather than having a huge spike and a huge downfall, which is horrible. Like, you don't want to own a stock like Intel that is still down from its all-time highs. In the last 5 years, it has returned 254%, which works out to be around 50% per year. So you'll be making 5 times the average market return. And since it's an index fund, it's considered more safe than owning individual stocks. The current share price at the time of research was $416. And for those of you who love dividend yields, they even provide dividend yields because some of the stocks in this index fund are cash cows. They already went through their growth stage and they're currently pulling in those profits. And the reason why I have invested in Vanguard Tech and basically all my shares are in technology companies is because I'm a believer in innovative companies. Because in developed countries, according to economics, it is those technology companies that will help grow a country. Therefore, I want to be invested into technology stocks, into innovative companies that will continue to grow our society, improve our society. Thanks.